Hey everybody, good evening. You probably know my name is Tom Schmidt. I am the co-founder of Ticker Tape Investments with Rita Carpel, and we are thrilled to be here tonight for another installment of the TTI Educational Series. This one's called Out of the Stock Market and Into the Driver's Seat. The idea is this continuing discussion of the fact that investors, frankly, I think have been misled over the decades as to what percentage of their portfolios should be contained in publicly traded securities. And certainly there's a valid place for those in every portfolio. The ability to have quick liquidity for situations where you need it is important. But the reality is that the ultra wealthy, the folks that have access to the best advice, are putting much more of their portfolios into alternative investments, or let's just say non-publicly traded assets. Obviously, we've done a bunch of presentations about various components of this idea. Tonight, we're going to talk about some sort of big picture idea of why this is important, how you can start to make that transition, et cetera. So the first thing is, why are traditional portfolios failing? And the answer really has to do with correlation and volatility, right? So the first thing is, it turns out that volatility destroys wealth. And the reason for that is, if you think about the stock market, if the stock market in your portfolio goes down 30% from, let's say, 100 to 70, if it goes back up 30%, you only have 91, right? Because 30% of 70 is 21. So add that on to 70, you have 91. So even though it went down 30 and up 30, you are not even. And so it's that volatility that ravages portfolios over time. Now, you may not see it because overall you may be generating a positive return. Let's just say you get on average 9% positive per year. You feel like you've done a good job. But the problem is that the same return in privately held markets, where you don't have 10%, 20%, 30% declines, you don't have volatility eating up that return. So your net return is much higher. So that's really the biggest thing. Additionally, investors, and I've been guilty of this many times during my life, for periods of time, not paying attention to inflation hedges, not paying attention to tax benefits, not paying attention to making full taxable contributions. Of course, I've always done the maximum 401k or the maximum IRA, but there's other things you can do to get access to more tax deferred investing. So those sorts of things, if you're not doing those, your portfolio is going to fail. And of course, I mentioned volatility. That to me is the biggest thing, and that's what the ultra wealthy are educated about. That the rest of us, they don't tell us that, because again, Merrill Lynch and Fidelity and Schwab, they don't want you to take your money out of the public markets, because that's the only way they make income, is for you to be trading in the stock markets. And so it's important that investors learn how valuable it is to have, in my opinion, the majority of your portfolio outside of the public markets. To me, if it's good enough for billionaires, it's good enough for me. So some of the things about moving your investments over to privately held deals that I think are important and valuable are, number one, of course, control, right? So now you can control the valuation at which you invest your money. Hey, I want to put money in a multifamily property. Well, I can look at 10 and I can find the one that has the best valuation, the best upside, etc. I looked at a deal today, and I have sent an email to the promoters, the principals, GPs, and asking a question. So I haven't heard the answer yet, so maybe I'm mistaken about this, but having read sort of the teaser on their new deal, it is an investment in a general partnership, so we would be a limited partner, and there's a complicated structure of preferred return, some of which is paid, some of which is deferred, but there's no mention of an equity upside. And so I've talked to a lot of investors like, oh, I invested in these 3 apartment deals with this guy. My first question is always, what percentage of the upside do you get? And I've had people tell me, like, what are you talking about? That's not a thing. Like, of course it's a thing. You get a preferred return plus you should be getting something like 70 or 80% of the equity upside because it's your money that created the upside valuation. The principals should get a cut. They should get 20%, maybe 30%. If they're really good at what they do and they don't need your money, then maybe they can get 40 or 50%. But 100% is not okay, right? And investors, if you don't, people aren't telling you that, if you're not seeing enough deals to realize that, you can be taking advantage. But I can look at deals and decide where to put my money. I can influence governance decisions of the various deals. Maybe I can negotiate the terms on which I invest or not. If they want our money at ticker tape, they're going to have to do it the way I want. Maybe they have to give me extra preferred return or extra equity split. And then, of course, transparency. I'm getting full financial reports. I'm getting updates, meetings with the management team. Maybe I go visit the property, whether it's a storage facility or a multifamily or an emergency room or whatever it is. And then, of course, fees. Now, this is a sort of a double-sided sword as well here because the fees can be way too high, right? But the difference is that if I go to invest in the Schwab S&P, growth fund, I get no vote in what fees I get charged. And a lot of times I can't even decipher what the fees are. In private equity deals, because we're ticker tape and we aggregate money, we're negotiating better fees for ourselves. And so again, if I pay a high fee, that I may choose to do that, but I don't have to, right? I can choose to go somewhere else and get a better deal with fewer fees. Again, if you haven't seen the multiple presentations that Ticker Tape has done on this topic, make sure you either watch someone else's or watch ours and understand the fact that private equity tends to outperform the stock market in any period of time you look at. Why? First of all, it's earlier stage, right? So Wall Street is not in it for you. When a Wall Street bank takes a company public, they're not doing it for you. They're not even doing it for the company that's going public. They're doing it for the Wall Street bank, right? So they're only doing that at a price that has allowed them to make all the money on the front end, right? And think about it. You can see an IPO deal and be like, oh, Goldman Sachs made $3 billion in fees on that deal. Well, that's added on to the market cap of the company. In other words, you're paying for that. Like you can fool yourself into thinking, well, the company is paying those fees, but they're not, because if the company didn't have to pay Goldman Sachs, they could lower the share price and you'd be paying a lower price. So you avoid those things if you invest in private deals and you don't have that extra fluff, if you will, on top of the valuation. Again, lack of correlation is enormous, and this is very important, right? So the performance of the economy and the performance of the stock and bond markets are more or less correlated. You want to be aware that's two different things. And like, I want to invest in companies that are going to do better in a recession. Like one of the things we're looking at right now, we're actually going to do a bus tour on July the 9th on a self-storage investment opportunity. If y'all are interested in joining us, it's in Houston, July 9th. Give Rita a shout. But that's something that if the economy were to decline, people put stuff in storage, they move out of their bigger house into a smaller one, and what do? You got to store grandma's furniture, right? So you want to look at those, but still, if you were to invest in a publicly traded storage facility, it's going to get negative pressure in a down market. But so you want to make sure you're investing in things that aren't going to fluctuate lockstep with the economy or with the stock market. First I thought Bitcoin was a great example of this, but turns out, no, the more the stock market goes up, the more Bitcoin goes up. When people get afraid and they start de-risking their portfolios, they're selling their Bitcoin also. So it turns out not to be a hedge at all. So you got to watch those things, and you want to make sure you're investing in a diversified set of sectors and companies and promoters. Don't invest in hotels, self-storage, and apartment complexes all from the same GP. You want to spread them across different groups. Even just your multifamily investments alone should have different principals in different geographic markets, maybe different classes of properties. Get that diversification deep to help minimize your risk, and it will, in the long term, improve your overall return. The other thing is, to me, pre-IPO deals are where it's at. I've talked to a lot of people and kind of analyzing their situation. I think for most people, you can build the middle of your portfolio with pre-IPO low risk deals and then expand out from that to get diversification. You definitely want some things that cash flow that are not pre-IPO deals. You definitely, like I said, you want some liquid deals that are already publicly traded. But in terms of the risk return profile, go watch the presentations we've done about pre-IPOs. We think that's kind of the place to be. Next is, first of all, you should rebalance right now. Most of you, if not all of you, have too much of your portfolio in publicly traded stocks and bonds, whether it's international, US, high risk, low risk, value, growth. Too much of your portfolios in publicly traded markets. So start moving that out now. But remember, don't ever forget the word rebalancing, right? Next year, the year after, if your Tesla stock shoots up, you need to sell some and buy other stuff. One example of this is we have an investor. I don't think he's listening today, but I won't call him out so I don't tease him too much. But he was telling me about his portfolio, and he's like, I've got 600,000 in this retirement account, and I've got about 500,000 in cash, and I've got this other asset that's going to liquidate for about 600,000. He said, I've got $850,000 of crypto. I was like, oh my God, that's way too much crypto. Well, what happened is he only put probably 10 or 15% of his portfolio into crypto, but it went up so much that now he's at, a quarter or more of his total assets. So we said, hey, you got to start selling that stuff. Every time you see one of the different cryptos pop up a little bit, take some off the table and let's move it into other asset classes and make sure you're protected. I think we've covered diversification, strategic cash flow allocation. So again, this is one of those decisions that is affected by how close you are to retiring. And as you get closer to retirement, you want to have more assets invested in things that are going to generate cash flow. Make sure you watch our presentation on how to allocate your investments across your different accounts. It breaks my heart when I see folks create a self-directed IRA, which every one of you should do. But once they do that, then they invest in a leveraged real estate deal in their traditional self-directed IRA, and now they have taxable income on their IRA because of the business tax that you have to pay. So make sure you know what investment goes in which account and manage all that. If you have questions, reach out to Rita. We can help you with that as well. These are some examples of different allocation models. I don't like these tags, but I thought about changing them, and then I thought, no, I guess it's kind of common language now. But this says conservative and then balanced and then aggressive. And basically the difference is this has 20% in alternative investments, 80% in traditional, meaning publicly traded assets, balanced 40-60, and aggressive 60-40. So first of all, I don't consider this to be aggressive at all. I think this should be your minimum. You should have oil and gas partnerships, multifamily, things like RV parks, maybe some vacation rental investments. We have hotels, restaurants, emergency rooms, surgery centers, all these different asset classes. Also, all of our pre-IPO deals go in here. And remember, when we buy SoFi, it's privately held. It goes on the 60% side. When it goes public and we sell it immediately, we're moving it back and taking that cash and putting it back into the alternative side. And then you could play with these subdivisions, 15% private credit, 20% real estate, 25% private equity. Different people are going to have different percentages here. But if I were you and I wanted to have a more balanced portfolio that is less risky, or even go all the way to the conservative side, my advice is keep the 60-40. But make this allocation less risky, right? Less private equity straight up deals, maybe more pre-IPOs, maybe less risky real estate deals, more well-established cash flowing real estate deals. maybe less of your portfolio in a E&P oil and gas drilling opportunity, but more in a deal that's buying royalty interests that are already cash flowing and have been for years, that kind of thing, right? So make more conservative private investments rather than, I mean, because look at the volatility that this person is going to suffer with, I don't care how safe their assets are, right? Look at the safe investments you're going to think of, you're going to put in the stock market today. Go look at what they did in 2001 or 2007 or 2020, right? They tanked. And so there's no way to really avoid volatility in the stock market. Much safer to have more of your money in private equity. And then if you want to be more conservative, pay attention to the allocation of your privately held investments to make sure they're on the safer end of that spectrum. Again, call Rita if you have questions. We have a lot of content we published on these topics that you can rely on to figure out this complicated stuff. Another big deal, which we're going to talk about a lot more in coming months, we've hinted at it in some of our content, but number one, you got to have self-directed IRAs, both Roth and traditional. If you have an IRA account that a former, if you have a 401k account that's at a prior employer, or if you've converted it into a traditional IRA at Schwab or Fidelity or one of those places, call Rita first thing right now, text her, get a call set up. Let's talk about getting you with one of the self-directed IRA companies where you're not limited in what you can invest in. You want to buy gold coins, physical gold coins. You want to invest in oil and gas. You want to invest in a hotel. You want to invest in a multifamily property. You can do all those things. We can tell you how to do it. We don't make money on it. We're not going to get a fee or a referral fee or anything. We just like helping investors. We'll direct you to the people you need to talk to get all that set up so that you can invest in private deals through your IRAs. Accelerated depreciation, if you are a high income earner and you have a lot of taxable income you want to shelter, we can point you in a lot of different directions of ways you can cut your income taxes, whether it's investing in oil and gas or heavy asset real estate, or buildings that can be depreciated. We had a bus deal. I don't have one right now. We used to have a bus deal we invested in where they were buying new buses and then writing off 100% of the value of the bus. And so that depreciation flowed to the investors, and we got tax deductions. We made our investors active managers of the business, so it was offsetting active income. Lots of strategies we can help you with there. And then also make sure you're timing exits. This is pretty obvious stuff. If someone's going to liquidate an asset for you in October, November, December, make sure they don't do it till January. In other words, let them sell, but give you your money after the end of the year. So at least you can defer that tax. Also, I had a deal where we were getting we have a piece of real estate that was being leased for oil and gas, and they were going to write us a big check. It was a 3-year deal. So it was the one check today for a 3-year lease. I said, the first thing was, I said, okay, I got to decide, do I want it in 2024 or 2025? Maybe I have too much income in 24, or I'm expecting a big income event in 25, so I want to manipulate where that money goes. Turned out it didn't really matter, or I think partly it was like too much cloudiness. I didn't know what was going to happen. So I had them do half and half. I said, pay me half in 24 and half in 25. So I got one check December 20th and one January 10th or something like that. And so we straddled 2 years. Do those kinds of things to minimize taxes. Now, here's why, right? The why. First of all, if you work with Ticker Tape and Rita and I, and we go through and we look at all these different tax strategies you've never even heard of, things like hiring your grandkids, leasing your house for 2 weeks a year to your business, all these tax strategies that we can help you save money. Imagine in your head a number. What amount can we save you per year on your tax bill? Let's just say it's 10 grand, right? We've saved guys hundreds of thousands of dollars a year, but let's just say it's 10 grand a year. Well, it's not just 10 grand that you save, because that $10,000 left in your pocket, instead of giving it to the government, what are you going to do with it? Invest it, right? So it's that 10,000 with an expectation, we're looking to generate 20% per year in your private equity investments across the whole portfolio. Some will be less, some will be more. Some of them you'll make 8 times your money. Others you may only make 7 or 8% a year for the next 5 or 6 years. But on average, our goal, we're trying to get in that 20+% per year. Well, what is that on 10 grand every year? So remember, this year you got 10 grand. Next year, you're going to save another 10 grand on your taxes. You're going to invest that. Then you're going to save a third $10,000. You're going to invest that. And if it's growing at 20% per year on average, it's a lot more money than just the amount of the tax savings. So it's definitely worth it to literally go through from top to bottom, everything in your personal life, your business life. Where can we find little bits and pieces we can save, little things we can do that don't change your life at all, but generate a tax savings that then gives you more cash to invest, and you multiply that benefit. How do you get started? Well, the hardest part, of course, is the finding deals. I call it deal flow and due diligence, right? So the first thing is you got to get access to deals. You got to have a lot of them, right? Because if you're going to invest in 7 deals or 5 deals, you need to be looking at 20 or 25, right? So that's not, you can't just flip a switch, right? That takes some effort. And let's just say you knew me, and you're like, well, Tom's going to show me 20 deals. I don't know if we get that many, but it'll be a lot. But that's not good enough, right? So in other words, even if you got 20 or 25 deals to see, if they all come from the same pipeline, that's not terribly helpful, right? Because there's some defining characteristic. Why did Tom look at those deals and show them to me? Well, there's some reason, right? Maybe Tom doesn't know what he's doing. You got to find, a Dave and a Mary and a Sally and a blah, blah, blah.com to find lots of deal flow, so you start to understand what's out there. Like I said, there's a very sophisticated investor. His net worth, I don't know it, but I'm going to guess it's $15 million, his investable assets. And the guy didn't know that he should be asking for an equity piece in his multifamily investments. It's like, oh my gosh, But it's just because he hadn't seen enough deals. He's investing in the deals that happen to fall in his lap without really evaluating them and without looking for other deals and finding out what's out there, right? And so make sure that you don't just go online and look at the first pre-IPO deal and invest in that, because I can almost guarantee you'll overpay. And so make sure you have good pipelines developed. You know how to do due diligence. Again, what did I do? Right? I'm a reasonably smart guy. I certainly know how to do all these things, but I'm not doing it on my own. Right? I built Ticker Tape Investments with 300 plus active investors who are helping with all of that. They're helping me evaluate deals. They're bringing us deals. They're vetting deals before they even mention them to us. And then also one of the best things we get is people come to us and go, hey, Tom, I wanted to tell you, I saw this deal. I think it's a bad deal, and I'm not investing in it because of this, but I wanted you to know about it, right? Because that's more data for us. You got to kind of build that sort of group. You're happy to tag along with Ticker Tape, of course, and we can point you in some directions of Facebook and LinkedIn groups that have lots of deal flow, online marketplaces and investor clubs and groups and private equity organizations you can become a part of. Like another example, I've done more now, but originally I invested $25,000, a tiny investment, in a private equity group called Alumni Ventures. So they put together a fund for each, it started Ivy League, but each top university. So they have one for Stanford, one for the University of Texas, one for each of the Ivies now. And so I went to Penn, so I invested in the Chestnut Street Ventures Fund. Why? Because it got me access to the deals that they were seeing and investing in, which gave me data and input for private deals we want to look at. That sort of stuff is what you can do. Of course, if you don't want to do those things, join Ticker Tape or some other group, and in an environment where you don't have to invest in every deal. You can see the deals that Ticker Tape is doing and pick and choose the ones you invest in. That's sort of the easy way. Make sure, and this is a big one, understand the timeline of each investment. If you invest in a private company that's not like pre-IPO, this is an ongoing business, there's a bell curve that represents the probabilities of what's going to happen with your investment. And the reality is there's a very low, I guess I need to do it backwards. There's a very low probability of you losing all of your money, but but it's a probability, it's there. And there's a very low probability of you making 40 times your money, right? Whatever they're going to tell you the upside is, it's actually a very low probability. What's the most likely result? The short answer is nothing, right? The short answer is you invest, they never really get to a point where they have liquidity or they go out of business. They just kind of chug along forever. You're not liquid and you stay there. So make sure that you understand the probability of that happening for that specific investment, what that timeline might look like, what the risks are, et cetera. Make sure you understand that before you deploy your capital. It doesn't necessarily mean you don't invest in the deal if it's going to be a longer term thing, but it might impact how much you put in that particular deal. SpaceX for us is a great example. I told everybody, I said, listen, do not invest in this to get a return. Do not even invest in this to get a return for your children. If you invest in SpaceX in, this was, I guess, 2023, you're doing it for your grandkids and your great-grandkids, and for the fact you can say, hey, I'm a SpaceX investor. And so just be aware of that fact. So what, the main thing is take action. Don't just waste this time that you've listened to me tonight and do nothing about it. Make sure you take some action and move forward and start taking advantage of these strategies and these benefits. It's what billionaires are doing. If you don't believe me, go Google it and look at how billionaires invest. Look up the modern portfolio theory, the Yale Endowment Fund and how it was managed, what its portfolio breakdown looks like, and learn from that, right? There's a reason why wealthier people invest like that. The answer is they're getting rid of volatility and correlation. Right? They're literally taking less risk because they're not in the public markets, and they're getting a better potential return because private investments tend to outperform. That's kind of the short story. So next steps, just reach out to Rita Carpel. Best thing to do is shoot her a text at 832-459-7335. You can also email her. Happy to make any introductions to you need. You need a trust and estates lawyer to set up a irrevocable complex trust with a family foundation and start down the road of avoiding income taxes altogether. Hey, I need access to what deals are out there. Can you connect me with some people who can help me find advantaged multifamily deals or hotel deals or healthcare deals or pre-IPO deals? Or, hey, where can I see the content you guys have created about pre-IPO? Just reach out to Rita. She can help you with any of that. Of course, Ticker Tape currently has 4 pre-IPO deals open now. We also have a merchant cash advance deal that pays 15% per year. We have a multifamily deal, a vacation rental deal, and I think that's it. And then these 4 pre-IPOs, of course, Utility Rescue is the one we are most excited about. Kraken we've already done a round of that. It's going public next year. So very excited about that one. That's going to be a home run for sure. But we're doing another round of that. SpaceX, we're going to do another round of SpaceX here in the coming months. So if you want I say in a month probably. So if you want to get in that, reach out ASAP. And then Anthropic, we've been trying for a year to get a deal that we like on Anthropic. Looks like we may finally have it. So if you're interested in AI, that's a great one to start with. It's kind of the good guys of AI. With that, I'm going to let you guys go. We went a little over time tonight, but it was important information. We'll see you next Thursday on the next TTI Educational Series webinar. Take care.